The banking crisis is getting even worse, and in coming days and weeks, even more banks could fail. With the New York Times reporting that small banks are rushing to reassure investors as shares plunge, with PacWest and Western Alliance being the latest casualties. You gotta talk about the risks to you of these bank failures. Number one, biggest risk is that if you have your money with a bank that fails, you could lose your money if you have deposits over the FDIC insurance limit of $250,000, which is why lots of wealthier people are frantically pulling their money from some of these overlevered regional banks. Watch out for these overlevered banks where their loans as a percentage of deposits are really, really high and elevated. You can see First Republic was number 1, Western Alliance number 2, PacWest number 3, with some of these other overlevered banks potentially running into issues as well. Because when a bank is overlevered and then their deposits drop by even more, they don't have the cash and liquidity necessary to keep funding their operations, which then freaks out the stock market and causes the bank's stock to crash, which then scares more people into pulling money from the banks and thus creates a vicious cycle that causes a devastating bank run. Which leads to the next question we need to answer, everyone. What's going to be the impact of these bank runs and bank failures on the US economy? And in particular, how bad is the resulting credit crunch going to get? Because right now, the growth in loans in America, the growth in credit has decelerated sharply in the last month to 9% year over year. And what's concerning is that every other time you can see sharp deceleration in loans in the US economy, what happens? Well, there's a recession. These yellow recession bars always pop up after there's a bank credit crunch. Because I want you guys to think about and put yourself in the shoes of a CEO of a regional bank in America. They are freaking out right now because they do not want to be the next bank that gets a bank run and has to shut down. And in particular, it's the banks in the top left of this graph that could have some issues because they're the ones that over the last year had high loan growth combined with big deposit loss. And all the way in the top left, you can see First Republic, where their deposits went down 35% and their loans went up 23%. That's the combination for a bank failure. What other banks are in this type of situation? Well, we have PacWest Bancorp, we have Western Alliance, we also have Metropolitan Bank, we have Comerica Bank, we have Zions Bancorp, we have Truist Financial. I also have some concern with some of these banks in the top right, like US Bank. They grew their loan book 22% year over year. Now, granted, their deposits grew a lot. They acquired another bank, so they're not in like a crisis stage yet. They still have plenty of deposits, but if their deposits were to go down, then all of a sudden they would be left in a tricky liquidity situation. Now, to be clear, I am not predicting that those banks are going to fail. I'm not predicting that they're going to have a bank run. I'm merely pointing out that they fit some of the criteria and characteristics of the banks that have already gone under in terms of having a higher expansion of loans and having a higher loan to deposit ratio. And look, folks, if a bank fails, it's not necessarily the end of the world for the depositors of that bank. If you have your money in a bank that fails, like I said before, if it's below the FDIC $250,000 limit, you're covered by the government. Conversely, another big bank could come in and buy the failing bank. That's what happened when JP Morgan Chase took over First Republic after First Republic failed, which was the biggest US bank failure since 2008. JP Morgan acquired all of First Republic's deposits and a substantial majority of their assets, meaning that JP Morgan now has nearly $3 trillion in bank deposits under their watch, which is a little scary, everyone, because the big banks in America are just getting bigger and bigger and bigger. A trend that's been occurring over the last several decades, where back in the early to mid 80s, there was 14,000 banks in America. Well, that's now collapsed to barely over 4,000, a 72% decline in the number of commercial banks in America since the mid 80s. And one thing you can bet is that the big banks are having a field day right now. JP Morgan got a sweetheart deal on their takeover of First Republic. According to Wolf Street, JP Morgan is projecting an IRR of over 20% on the deal, with the FDIC guaranteeing over 80% of the losses that come from the single-family mortgages that they bought and 80% of the losses on the commercial loans that they bought with the takeover of First Republic. And ultimately, what I fear is going to happen is that these big banks are just going to sit back and wait. They're going to wait for more of these regional banks like Western Alliance and PacWest to go under, and then they're going to come in and pick up their assets at a discount with maybe a government guarantee thrown in there. And that's something that ultimately is going to make the credit crunch I talked about before even worse, because what's the incentive that any bank in America has to lend right now. The small regional banks, they're not going to lend because they are scared that they're going to go under over the next couple of weeks. Meanwhile, the big banks who are in a healthier position, they theoretically could lend, with the aggregate loan to deposit ratio in America's banking system being only 70%. That's below the long run average. There are enough deposits in the system to justify more lending from the big banks. But why would they do it? Why would a big bank make a new loan when they know that they could just buy a loan at a discount with a guarantee from a failing bank? And ultimately, the real reason that declining bank loans and bank credit is a problem for the economy, and it's going to cause layoffs and bankruptcies and home prices and stock prices to go down, is because our economy runs off debt. Our economy needs continued infusions of new debt to support asset prices and to support hiring. And then when you just even decelerate the issuances of new debt, it creates big problems. And to understand this point, just look at the total level of corporate and business debt in America, which according to the Federal Reserve reached nearly 20 trillion at the end of 2022. That's right, folks, 20 trillion in corporate and business debt. That's a record high. And that's double the level of business debt that we had in our economy in 2008, before the worst crash since the Great Depression. And who provides that debt? It's the banks. So if the banks can't provide that debt anymore, our economy is going to come crashing down. And ultimately, I fear there's just going to be more bank failures, because when you zoom out at the macro level, the real reason this is all happening, the real reason we're having bank failures is because of Jerome Powell and the Federal Reserve. Their aggressive interest rate hike regime over the last year, combined with their quantitative tightening program, has resulted in a contracting money supply. First time the money supply has contracted in nearly 90 years since the Great Depression. And all the other times we've had money supply contraction in US history going back to the 1800s, we had depressions and a panic. And so long as this money supply contraction continues, which it looks like it will, the Fed just hiked rates again, they're going to continue to do quantitative tightening, and the banks are likely going to cut lending. All of that's going to mean less money in the system, which is going to increase the odds that more people have liquidity needs and pull money from the bank, which is going to increase the odds that there's more bank runs and failures. And what's scary to me is that not a single reporter asked Jerome Powell yesterday during the FOMC press conference about the money supply. There wasn't a single question about it, even though it's the root cause of this banking crisis. And that leads me to believe there's just a gigantic blind spot, and the Fed is just going to continue to aggravate the situation and tighten money further when we have the biggest bank failures of all time occurring. I mean, how crazy does that actually sound, folks? The Fed is tightening money supply even more when we have the biggest bank failures ever happening. And the whole reason the Fed is still tightening is because they look at the headline data on inflation and on the job market, and the headline data still looks robust in some instances. For instance, the ADP National Employment Report said that the US added 296,000 jobs in April. So this labor market, despite, all the predictions of recession that I'm making and other people are making, it's still chugging along, and that's causing the Fed to continue to increase interest rates. But folks, I noticed something funny about this jobs report when I dug into it, and that's the composition of where jobs were lost in America. Take a look at this. The growth in jobs at the national level happened mainly on the Pacific coast of America and in the Northeast, while the South in America actually lost jobs. The South lost jobs in April and has actually lost jobs every month of the year, according to this ADP jobs report. So we could be seeing a reversal in the pandemic trends in the economy, where, the South boomed during the pandemic. The Northeast and the Pacific got hit hard by the lockdowns they instituted, lost a lot of jobs. Well, maybe there's a reversion in that occurring, where the Pacific and Northeast is now adding back the jobs that they lost, while the South is the first to really lose jobs substantially in this recession. And if this trend holds of the South losing jobs, this could be a big problem for the housing market in the South, because that's where home prices boom the most. That's where there's the most home building by far right now. There's really no margin for error in the housing market across states like Florida, Tennessee, Texas, and South Carolina. And it's in these states in the South where inventory on the US housing market has grown the most over the last year. Look at this, everyone. Data from Realtor.com shows, for instance, in Florida, inventory has grown 116% year over year. There's more than 2 times as many listings on the market today in Florida as there were a year ago. In Texas, inventory has grown 97%. In Tennessee, it's grown 104%. In South Carolina, it's grown 99%. And perhaps the reason inventory is growing is because of these job losses in the South, whereas up in the Northeast, in New York, Pennsylvania, New Jersey, inventory is flat. It hasn't grown. And in California, on the Pacific, inventory is only up 14% year over year. But ultimately, folks, I'm going to be honest. I think the Pacific part of America, like California's economy, I think California is screwed. Because when you look at where these bank failures are happening, it's in California. Silicon Valley Bank, First Republic Bank, PacWest, they're all headquartered in California. Western Alliance, they're headquartered in Arizona, but they do a lot of business in California. So the fact that the regional bank failures are happening on the West Coast of America means that the credit crunch I described in this video and the reduction of loans, it's gonna hit the West Coast first. So I don't think the Pacific region of America is gonna keep adding back jobs for long. At some point, this credit crunch in 2023 is going to turn into job losses in states like California, Washington, Utah, and Arizona. Now, before signing off, I'm going to leave you guys with one big piece of information that I think is important to understand if you're concerned about your money and where to put it. And that's going to be banks that I think are healthier and are more likely to avoid issues in this banking crisis. And the main metric I'm looking at here is loans as a percentage of deposits. We see First Republic, Western Alliance, PacWest at the top. They're overlevered, having issues. Conversely, we have some banks here at the bottom of this list with a relatively low level of loans. They're not too levered. JP Morgan is one of them. They have a much stronger balance sheet, 1.1 trillion in loans compared to 2.0 trillion in deposits, 47%. Citigroup, 48% loans as a percentage of deposits. Bank of America, 54% loans as a percentage of deposits. So for now, the bigger banks appear to be safer bets due to lower leverage levels and having higher deposits, which makes them less likely to be a victim of a bank run. However, this banking crisis is fast moving. Nothing's a guarantee. And what's shocking to me is how nonchalant our leadership is about this banking crisis. Jerome Powell, Janet Yellen, they keep repeating that the banking system is sound. But how could the banking system be sound if we're literally having the biggest bank failures ever occur? Because looking at this data from the FDIC at the 10 biggest bank failures in US history, you can see First Republic is number 2, Silicon Valley Bank is number 3, and Signature Bank is number 4. Those all happened in the last couple months. And if PacWest and Western Alliance go under, they would be numbers 5 and 6. And so this is some crazy stuff we got going on right now in 2023, everyone. These massive bank failures, the money supply contraction, the huge levels of corporate and business debt, the housing bubble, the fact that the Fed is still tightening monetary policy throughout all of this, it creates huge downside risk for the economy as well as asset prices. So watch out and be careful.